Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Michael Holman. Michael is a VP of Development and Capital Markets at Overland Group, a vertically integrated real estate firm. As VP, actively oversees the development and financing of over $160 million worth of real estate. He's helped his company go from $6 million to over $150 million, which I'm pretty sure he said in the interview that it's $200 million or more now in development in 4 years through his relentless personality and ability to build meaningful relationships. So through this interview, you are going to hear how partnerships, and from what Michael said, fuel to the fire. I mean, just lit the jet engines and helped them to go so much faster. You heard an interview with his father, Ken, on here probably 1 to 2 years ago. Can't remember the exact show number, but I would encourage you even to go back and listen to Ken as well. They just have a great business in developing some phenomenal deals or projects. But as far as Michael, he goes into a deal specifically that they had some difficulty with financing, and talks about how they use a TIC structure and 1031 funds and special purpose entities and some different things that I'm sure will be helpful to you, whether you are an investor or whether you are an operator or both. You're going to learn something from this interview. He goes into many different things about mentors and different things that would help them to scale fast. Hope you enjoy the show. Michael, welcome to the show. I'm looking forward to just hearing your story. I mean, just reading your bio personally, I just see the experience that you have in our industry and in the space and how fast you've been able to move. I know that is what so many of the listeners are intrigued about. When I know they're going to want to know more as they get to know you more. Obviously, we want to know a couple minutes about how you got to where you're at, a little bit of your backstory, so people can relate and also give them hope to, hey, you know what? They can do it too. So give us a little bit of that. And again, welcome to the show.
Absolutely. And thank you. So my backstory, I kind of took a little bit of a different path, but it's similar to a lot of people's stories in this space. So I came out of school. I got a master's of accounting. I went and worked for a Big Four accounting firm, Ernst & Young. And I was there for a little while, earned my CPA. And honestly, I was less intentional about getting into this space than probably most people. I mean, I had listened to a few podcasts and done some things like that while I was at Ernst & Young. But actually, my father, Ken Holman, he's been in real estate and doing real estate development for over 40 years now. And so I just kind of grew up surrounded by real estate and real estate development. And after a little while at EY, he actually came to me and said, hey, I got an opportunity. I need someone to fill a development role. Do you want it? And I was really hesitant at first. I wasn't sure if that's what I wanted to do or not. The company was in this little bit of a transition phase. But at the end of the day, it was my swing for the fences moment, right? I figured, hey, I'm young. I got my CPA. I got something to fall back on. Let's go for it. And that's really where it all started and how I initially got into real estate. So
did you feel like that there was like a massive sacrifice there? And maybe you can help relate a little bit to our risk, not so much sacrifice, but risk around, hey, taking this massive shift. And maybe you received some pushback from other people. I don't know. I was actually with an entrepreneur yesterday that I respect in a big way. And he was asking me about my background, and I shared about the, military, law enforcement and horse training, and then commercial real estate. And he's like, well, that just sounds like such a natural path. However, obviously not, but your father has been in this for many, many years, very well known, been on the show, great guy. And that would seem like a natural path to me, man, you have this amazing mentor, that obviously, better than probably almost anyone, right? And so, did you feel like that was risky, to make a shift like that? What were your thoughts then? Because I know there's so many that are listening that can probably relate to making a big change like that.
Yeah, I mean, it was risky for me, right? From an outside perspective, it probably doesn't feel that risky, right? You're thinking, hey, here's this successful real estate developer. You're coming in. I never intended on going in real estate. That wasn't kind of where I was headed. That wasn't my path that I was headed down. And so when I was going through school, right, I didn't have in the back of my mind, I'm doing all this so I can go, work in the business someday. I was just doing my own thing, right? And so Ernst & Young, when I left, they had 220,000 employees. Your pay increases are very set, right? I mean, you could talk to almost anyone. It didn't matter where you were. You just had to figure out how long they'd been at the firm, and you could pretty much tell what their salary was going to be. The increases were that set, but they were good, right? They were significant increases. One of the most stable jobs. I mean, rarely does anyone get fired from a Big Four accounting firm, right? Most people end up leaving. And so, and then where I knew the company was in this transition phase, right? Like most companies, we have ups and downs, right? We kind of have a roller coaster, and we were kind of a little bit in a down phase. We'd come off a really big phase, and we were coming kind of through a transition phase. And so, looking at it, I knew we had a good team, and that's really what convinced me to make the jump. But I didn't come in when I came in. The company wasn't just this uber successful. We had cash just coming out of our eyeballs, right? We just didn't know what to do with it. And it was like, hey, come over. I just don't know how to spend all my money and help me spend. It wasn't like that at all, right? We were scrimping, saving. We were really scrappy during that initial period. I tell everyone we're kind of like a 40-year-old startup, right? I mean, we have this great experience, but where we were in that transition phase, we were really like almost a brand new startup.
It's interesting. And even in your bio, you highlight it and wanted to bring it up, from 6 million in development to over 200 now, 200 million. 6 million. I don't know if I said that, but 6 million in development, but now 200 million, just in a few years, right? You all have grown so much. You got all this experience. Like you said, it's like you're a new startup, but man, you all been doing it a long time. But now all this growth and there's so many things there I'd love to unpack, but why? Like, what caused the growth? I know you started then. Was it, what was your role in that?
Yeah, so I bounced around. I mean, I came in to do development, started there. 3 months in, the controller quit, so I took over some of the accounting roles because it was like everybody just sort of looked around and was like, "Well, you're the CPA, you figure it out." So I came in and I had to figure that out, and then I started taking over capital markets, and then I went back and took over development again. So really, my role has been, where's the need in the company and how do I fill that? And that's really where I've kind of bounced around in. And that's actually given me a pretty broad perspective over things. And I'm really grateful to have that. So yeah, we've gone exponential growth over the last 4 years. And, we've done a lot of things right ourselves. We've been working really hard to acquire good property, find good property. A big portion of that I will readily admit is the partnerships that we've created and the relationships that we've established. That has been really the fuel to the fire for us. I mean, we're great in and of ourselves, but by ourselves, we couldn't have gone from 6 to 200 plus million. I mean, that's almost impossible for anyone to do unless you are starting in a really, really good spot from the beginning, right? So we've been very strategic about forming our partnerships. We have capital partners, we have great lending relationships, we have broker relationships. We have really dialed in on, who it is that we can benefit from and they can benefit from us. And let's team up and let's go forward like that. And that's really been the fuel to the fire for us.
Love that. And I'm so glad that you elaborated on, you call it the fuel to the fire. I mean, you mentioned that a couple times. I could not agree more. So many people have a scarcity mindset, right? I don't want to give any of the deal away, but I'm like, you'll do 5 times, 10 times as many deals, if you'll, and make 10 times as much as well, when you're willing to share, right. With other groups and you all go together, right. Rising tide, right. Everybody knows that saying, lifts all ships in their boats. And so exactly. Great. So what was the piece though? I guess I know you all are experts in development. And so you're willing though, you mentioned other capital partners, anybody else that was like, man, we need that person, let's partner there instead of bringing them on board as say an employee.
Yeah, the biggest piece I would say that we ended up really kind of forming together was the capital raising ability. And then we were able to fill in a lot of the real estate. When we came in, kind of when I talked about some of those ups and downs, right? The last up that we had formed a single partnership with a giant institution. And that's really, we rode that wave for a long time. And then all of a sudden that institution got bought by an even bigger institution. And that institution sent out an attorney to us and said, you have 90 days to sell everything. We've just decided that we have too much real estate and we need to offload. And we're like in lease up, right? So we are not at a time to sell. And so we're over here fire selling. I mean, this is 7, 8 major assets, right? 300 plus unit apartments, a golf course is even included in that. I mean, we had all sorts of stuff in this portfolio and fire sales. So that was kind of the rising ship. And then we went down and it was kind of like, it wasn't that much fun. How else can we get the money? Right. And so we started with some low level syndication. And then what ended up happening is we found a partner who had a little bit of experience raising capital that wanted to be where we were. And so we partnered with them. And it was funny. We've now done 3 deals together, and every deal that we do together, it's like, hey, this is a big deal. This is the biggest deal we've ever done. Right. And we get it done in like a week. And then the next deal will come, oh, this is a really big deal. How are we going to get it done? And that's just been a really symbiotic relationship. Right. Because they really understand the capital. They've been working with investors for a long time. And we really understand real estate development. We have lending relationships. We really had at that moment all of the pieces. We just hadn't focused on the equity capital side of things. And that's kind of the main partnership that formed that said, hey, let's take this. And now we've partnered with multiple people on across various assets on different projects.
That's incredible. Often people say, well, how do I get started? How do I scale like we have, or obviously like you all have that fast? And I tell people, man, it is a team sport, to say the least. It is a team sport. And often the guys that I see that seem to move the fastest are ones who have specialized, right? They're if you have 5 team members, right? If we're playing whatever kind of game, basketball or football, whatever, like you have this focus, right? This is your job on the team. And it's so the same almost, in the syndication business. And the guys that are willing to say, you know what, this is what I'm going to be really good at. I love this. This is what energizes me. I'm going to just focus on that. It's like those other team members come to you, right? Because they need what you have, and really you need
exactly
what they have too. It's I've seen it happen so many times. It's just so interesting. I did the same thing. Like I'm going to be great at this thing, and then build the team, right? Or find the partnerships. And so, Michael, I'm sure right now too, some people are saying, well, development, right now, why development? Why not value add? Everybody talks about value add, multifamily or whatever, some other asset class. And they're definitely not the same. So, why development? Let's go into that a little bit and help those that are listening right now, are wanting to syndicate developments and move into that, help them think through some of that.
Absolutely. Value add is, and to start off, value add's great, right? So really respect everyone who's doing value add. We do some value add as well. We chose to specialize in development mainly for a couple of reasons. First, it's a really high barrier to entry into development. I mean, when you're getting into development, especially on a large scale, let's say you're developing a 200 unit apartment complex, that might be $50-60 million. You have to put a lot of upfront capital and a lot of upfront risks. I mean, we'll spend anywhere between $50,000 and $250,000 potentially just on the project, getting architecturals done before we ever even have approval from the city that we know we can build what we want to build, right? And so there's this really high barrier to entry. Not only that, you have lenders that they're going to have more strict requirements. I mean, when you're doing construction loans, there's non-recourse options, but a lot of your best interest rates, they're recourse, and they want to know that you have the ability, the expertise, the knowledge to take a development from start to finish, right? When you have value add, there's less risk there. And you go out, you're generally getting a non-recourse loan. So you're not putting up these personal guarantees, right? When we do a development, we're putting up our homes, we're putting up our cars, we're putting up everything on the line to ensure that the development gets done. And so that's inherently a really high barrier to entry. Most people look at that and say, that's not for me. And so that's one of the main reasons. And the second reason we did it is really just the returns, right? I mean, we we love that value creation, right? And we love it to an extreme, right? So there's the value add, and we like the brand new development because there's just that value that's created. I mean, we right now are just about to start construction on a 240 unit apartment project down in Mesa, Arizona. It's going to cost us roughly $66 million. We just got an appraisal back for over $100 million on that property, right? That's $40 million of value creation there. And that's just something that's hard to replicate, especially in a value add, right? You're trying to get that in a value add, but it's a lot more cash flow reliant. We're a lot less reliant on cash flows, and we're a lot more reliant on that value creation, building something for just less than the market value at the end of the day. And so it's a little bit of a drug for us. We're addicted to that value creation, and that's what we really love.
It's an interesting dynamic, like the value creation, the way you do it in development. And I was thinking about, the building's created, it's appraised at 100 million. Well, there's, so much value there that's done the day that it starts operating, right? Where, in value add, we're creating a lot of value. However, I feel like in development, it's like you're working your process, right? You're working your team. There's obviously tons of things that could happen. You have to work through all those things. But I feel like in a value add space, especially multifamily, you're having to manage 200 different tenants at the same time, or just those remodels. And I feel like that could be even worse, right? Or more labor intensive. I could be wrong though. We're doing some developments now, but not, like the level you all are.
Yeah, no, I mean, you're definitely right. There's kind of a lot to manage on both processes, sure. Right? And really where the benefit or the risk reward comes in development is you're just taking on a lot more risk with a development, essentially. And that's what
there's no cash flow.
Right? Yeah, and I kind of laugh because that's what people say. I look at it and I say, is it risky? If you have a development team that has, over 70 years of experience, developed over, $500 million, really understand, is it more risky? But in the general view, right, it's more risky. You're taking on construction risk, you're taking on lease up risk, you're taking on all of these, sometimes you're taking on entitlement risk. So you're taking on all these risks. And that's really where the reward of that $40 million that we just talked about comes from, is when you're willing to take those risks. And so we're doing a lot of risk mitigation with development, right? I mean, development more so than even value add, I would say it's about understanding and having foresight, right? In development, it's really easy to lose 6, 7, 8, 9, 12, 24 months in the development process if you're just kind of getting tossed around, right? You're being really reactive. So in development, it's really important. You have to have the foresight to understand and say, hey, I know this is what they're going to need. Because when the city comes, by the time the city comes and tells you they need something, that if you don't already have it started, that's probably going to set you back 3, 4, 5 months, right? Right there. Yeah. So you have to have that foresight and that understanding. So having the experience of going through the process, super important. Anyone getting started, I'll just say my one piece of advice, anyone getting started or wanting to get started in real estate development, I highly, highly recommend partner with somebody who's been through the process. Even if you have to give up more than you think you should, that will be an invaluable learning experience, because in development, you don't know what you don't know. And it's hard to pivot around those unknowns in development, because you like I said, you'll easily lose 6 to 12 months.
Yeah, that is difficult, right? And unexpected, I'm sure, often, or you probably plan for a lot of that. But go into maybe that specific deal. Any difficulties? Anything? I don't know, maybe around financing or anything.
Oh my goodness!
Any issues?
Yeah. And financing, really, I mean, I kind of landed in a specialty in financing, right? Coming from my CPA background. But that deal, actually, we were talking about the 240 units. That was probably the most difficult deal we've had to finance in a long time. So we have a bunch of different components. So just across the whole capital stack, right? Or how we're getting all of the money. So we have a senior lender who's coming in for the main construction loan. We have preferred equity, and we also have our common equity, or all of our investors who are part of the project, right? So you have these 3 different dynamics already. But then within the equity or the common equity with the investors, not only do we have regular LLC investors, we also have multiple 1031 exchange investors or TIC owners. So now you get all of that combined with the preferred equity and the construction loan. My org chart is a full page with a lot of different boxes. So it's pretty intense, and it's been difficult to get everyone on the same page, because this is just, we're reaching a lot of unknowns. People are familiar with one piece of all of that, but they're not used to putting it all together like we have in this deal.
Could you speak to just the TIC structure, tenant in common structure a little bit, or special purpose entity, how you all have done that a little bit, or give some tips around making that happen successfully?
Yeah, absolutely. So an important thing when you're doing with TICs is you got to understand that some lenders and partners are going to work with the TICs and the 1031s, and some aren't. So if you're thinking about doing allowing 1031 exchanges, just first and foremost, know that you might have to pivot from your usual lenders, or you're not going to have as much flexibility as you might normally have in a deal. So just off the top, that's one thing to understand. As far as actual structure on how we do this, so we have the actual property, right? Like this 240 unit, that's the actual property. Well, the TICs, along with the LLC that we've created, this one particular is called the Falls at Chrisman Commons LLC, right? So that entity and all of the TICs actually co-own the property together. So all of those owners together collectively own the property. And it's a pretty small portion, right? I mean, on this deal specifically, the TIC owners or the 1031 exchange investors own about 10 to 12%. And we do a lot, because we only take 1031 exchanges that are looking to be passive. Right? These are people who want to be passive investors. It's generally, I mean, we get hundreds of calls like this every single year. I just sold my rental home. I'm gonna throw myself out a window, if I have to go fix another toilet at 2 a.m. in the morning, right? I mean, yeah. just people are frustrated, and so we get these calls. So we bring these people in. A quick tip on how you structure these: generally, when you're doing a 1031 exchange, that investor will create an SPE, or a special purpose entity. And that is the entity that the bank will actually recognize as the co-owner. And then how we do it is we put ourselves as the manager of that entity. That allows us to take care of all of the issues, right? I mean, that otherwise these TIC owners are going to have to sign all the loan documents. Anytime there's a major decision, they're going to have to be involved, right? And they're not looking for that in the first place. And so we do that SPE, we put ourselves as the manager, and then they get to basically be a passive investor. We have a TIC agreement that binds all of those parties together. And that TIC agreement essentially is a replicate of our operating agreement in our LLC. And that's what most passive syndication investors are used to seeing, right? They'll see an operating agreement and a PPM. Our TIC agreement basically looks the same as the operating agreement. And so that's kind of how we are able to mesh all of these different groups together. And so they're all treated exactly the same, right? The limited partners in the syndication are treated exactly the same as the TIC owners. The TIC owners just take a few more steps to really put it together the way it needs to be put together.
Yeah, no, I appreciate you elaborating on that, because that can be confusing often, especially to newer syndicators or operators as you're thinking through a 1031 exchange. Oftentimes groups will not take anyone unless it's $500,000 or $1 million or sometimes many million, in a 1031 exchange.
Yep.
Just because of that process you're talking about. Obviously there's quite a bit of legal fees, and I mean, it's got to be done though, right? I mean, you want to know that it's done 100% properly and legally. So there is some expense, but it can be very worthwhile for the 1031 investor and the group like yourself. So no, that's great. Changing gears a little bit. Tell me about your best mentor that you've ever had and why.
Oh, so we kind of already brought it up, but 100%, it's definitely my father. So Ken Holman, he was actually, if you've been listening to this show for a long time, he was actually on the show a while back when you might remember that interview.
I remember he and I talking about 1031 exchanges, I think, and some tax stuff that was pretty interesting.
Yeah, it runs in the family. You should see Thanksgiving. It's our wives and my mother, she can't stand it because all we can do is talk about real estate. But no, it's definitely my father. He's been doing this for 40 years. He's been an amazing mentor for me. And even though it's kind of funny, when you're in a family business, you realize that not everybody thinks similarly, and people are more open than they normally would be in a business. And so, even though him and I might have differing philosophies around certain things, he has been instrumental in helping not only teach me what I don't know, but he's always been really good at getting me to learn things for myself. I mean, it reminds me of a story when I was in 6th grade. So I must have been 11 or 12 at that time. I told my dad, I want a skate park. We need a skate park. I was really big into like rollerblading and skateboarding. I was like, we need a skate park in this city. And he was like, okay, you want a skate park? I was like, yeah. Why don't we have one? I already know the spot. It'd be perfect. He's like, okay. You want to know what he did? He took this 11-year-old. He got on the agenda for the city council of the city. And here this 12-year-old is going, 11 or 12-year-old goes and presents in front of the city council on why we should build a skate park in the city. Right. I mean, and that's just classic, right? I kind of laugh because that's been my whole life, including while I've been here, right? He's really good at letting me figure things out. And that's been a really important thing for me. Us Holmans are very stubborn and hard-headed sometimes, and we always think we're right. So to be able to learn and needless to say, we didn't get a skate park in the city. So I apparently didn't do that good of a presentation, but the experience was what was invaluable.
I was going to say that's an amazing mentor right there, right? Okay, let's put you in a situation that you already think you want to be in, right? Well, let's show you some of that process, put you in a situation where you're going to learn a ton while he's still standing there watching, right? Or ready to keep you from doing too much damage, I guess, right? But really, I mean, that's incredible. That's amazing. And yeah, a great guest, by the way. I would encourage listeners to go back and listen to his show as well. Just amazing family and group. But Michael, tell me a little bit about as far as development. How are you all preparing for a potential downturn? So many more people I feel like expect like this big thing to happen, over the next, 6 months to 2 years. How are you all prepared for that?
Yeah. I mean, the thing that the focus that we've taken is none of us here have a crystal ball. We're keeping up to date as much as we can, but we are as conservative as we can be while moving forward in today's world. And so what that means is, step one, we don't over leverage our deals. I mean, when you get into development, a lot of people want to get into development and they get kind of lured in by these people and these lenders who will come in and say, look, we'll loan you 100% of of the cost of your project. It's at 15% or 16%. It's going to be great. You're going to go up, you're going to make all this money. And by the way, you also have to personally guarantee it, and it's like things like that. That's really going to get yourself into trouble. So, I mean, we're almost always somewhere in the vicinity of 20 to 30% equity capital in the deal. That just gives us a little bit of a buffer. So kind of like step one. Step two, I mean, we do our best to really take on the due diligence on the front end of these projects, right? I mean, like I said, when you're creating $40 million of value, you have a lot of room for potential downturns, right? And that's one of the big things. I mean, capital preservation is huge. I mean, we're trying to get as much, the highest returns we possibly can for our investors. But when it turns into a downturn, the focus starts to switch and say, okay, capital preservation, that's the most important thing right now. And so with that, I mean, we've been able to really make sure on the front end of the project, because by the time you have a project developed and things are going, if everything you did was razor thin, it's a little too late. I mean, you're very reactive in that situation and you're just doing your best to kind of hold on. So that's really what we're focusing on right now, making sure that on our due diligence, we have as much give as possible, right? Which is hard in today's market. I mean, just to be perfectly honest, land's gone up, just like everything else, land's gotten more expensive too for us. And construction, I mean, talk about construction. We just dealt with 25% construction increases on some of our projects over the last year, which, that really hurt. The other thing that I'll say about that is when you go into a downturn, the most important thing is weathering the storm. And so being able to have access to capital, whether it's through a lender, whether it's through investors, whether it's your own money, whatever that is, access to capital can help you weather the storm. We're in a boom and bust market. That's the way our economy is inherently set up. And so you're going to have ups and you're going to have downs. They're inevitable. And so planning for the downs as much as possible. But if it goes down more than expected, you have to be able to weather the storm. And that's really comes in on how much capital do you have in the project and how much capital do you have access to that you can weather that storm and ride it back up.
I hope the listeners are listening to that. Man, that's such good advice. I mean, is a downturn going to happen? Well, if you look at history, probably at some point, right? But like you said, we do not have a crystal ball. But not being over leveraged and and having a cash or some cash on hand, right, is going to separate, right, the top operators and the ones who are trying to make deals happen that are too thin, like you talked about. Just great advice. And again, I know you do not have a crystal ball, but any expectations that you all have over the next, 6 months, year, 2 years? Hey, we know this is going to happen, or expect it, or anything.
Yeah. So what we're seeing right now in the development space, we're really focused on a couple of things like construction costs, right? That's one of those things that we've been tracking.
That's come down, right?
That has a little bit. And so we're optimistic that that'll taper off. What we're seeing and what we're expecting as far as construction costs, we think that materials will continue to taper slightly. The thing that we're kind of anticipating, though, is that labor costs are going to go up. So we kind of anticipate that whatever decrease we have in materials will likely be replaced by an increase in labor costs. And that's really where, I mean, you can see this. This is evident even if you have known nothing about construction. This is evident across the entire economy. I mean, just look at how many restaurants are struggling to get people, right? Tradespeople are in really high demand right now. And industries across the board are struggling to get and hire the people that they need. So inherently what happens, well, how do you get more people? Well, you pay them more. When you pay them more, that flows all the way up to us. So we're anticipating that there's going to be kind of this switch where construction costs, materials start to come down, but labor starts to rise. And we think that that's going to really counterbalance much effect and the excitement surrounding the decrease in labor materials. As far as, broader perspective, recession, things like that, or downturn, looking at that. I mean, we did just have a recession. It feels a little artificial and like it wasn't truly a recession, I'll say. I think I'm optimistic over the short term. I'm optimistic over the next 6 to 18 months that things are going to continue to go up. I like to listen to a lot of people that I consider a lot smarter than me. And what those people are generally saying is that this is a little bit different they see than in 2008. Like, take the housing market, right? We're both in apartments. I'm sure a lot of the listeners are interested in multifamily. Well, what we're seeing right now and what the experts are saying is that this explosion in demand really isn't, it feels like it's very, it's all of a sudden just come on the market, but this has actually been building for almost 10 years now. Builders in general have just been undersupplying markets time and time again. And then when COVID hit, not only was this buildup of undersupply, but you also had to bridge the gap of everything kind of shut down and just stopped building. And that exacerbated the situation. And then all of a sudden you have all these people that wanted to move into homes, through COVID. So you had this increase in demand. You had this already stressed supply chain that now became even more disparity between the two of them. And that's where you're seeing this. It's just trying to catch up right now. And that's what we're seeing. And it's expected to go like that for, another 6 to 18 months is what I'll say. I have a hard time forecasting beyond that. And I kind of laughed to myself. I was telling some people at our work just the other day, this is probably what everybody was saying in 2006, 7, and 8. Oh yeah, this is way different than the internet bubble. This is, things are going good. I mean, I started hearing, I will say some things that have concerned me on the flip side. I've heard a few people say, oh, you can't lose money on a house right now. And I'm thinking, I heard that phrase before. I remember in 2007, 2008, everyone, oh, you buy homes. You can't, homes always go up. You can't lose money when you buy residential real estate. And those have been some red flags for me along the way when I start hearing people say things like that. But right now we're really relying on those experts.
That's kind of like hearing that word, that G word, guaranteed, right?
Yeah, exactly.
Like, man, don't even say that. So changing gears again, Michael, what about some daily habits that you have or you are disciplined about that have helped you achieve this level of success?
Absolutely. I mean, two things that I'll point to. One I think is fairly common, and it's not a must-have, but I think it's fairly common among high performers. And that's just, I get up early, right? I get up at 5:30 a.m. every single day. And my general routine in the morning is I wake up, I have a morning routine. What I do in there is I pray, I meditate, I read a little bit, and that's kind of my morning routine, right? I have an affirmation that I'm saying. I'm just trying to start off the day right. And that's only, 10, 15 minutes. I exercise. And then my general routine, I try and spend a little bit of time with my kids. I got 2 kids, a 4-year-old girl and a 1-year-old boy. And while my wife goes and exercises for an hour in the morning, I try and take that time, between about 6:30 or 7 to 7:30 or 8. And I try and spend time with my kids. Because as soon as you get to work, right? I get to work between 8:30 and 9 into the office. Once that happens, the day is so hard to like refocus and reorganize. So that's really important for me. So that's kind of step one. The other thing that I'll say that's really turned into a habit for me, and it's a little more conceptual. I try and be where I'm at. And what I mean by that is when I'm at work, I try and be 100% committed to what's going on at work and doing the absolute best I can. On the flip side, when I'm with my family, I try and be 100% committed to my family as much as I can, right? And so that's been really important for me. There's been times that work has been busier or less busy, but knowing that when I'm with my family or when I'm at work, that the people there have my full attention, I think is really, really important. And that's one of the things that I've tried to just ingrain into, call it a habit or characteristic of who I am, but I think that's really important.
So true. Such a good advice. And it's difficult though, as entrepreneurs. I'll wake up in the middle of the night. My mind is just like going 100 mile an hour, and I've got to get up and like write some stuff down, right? So I can go back to sleep. It's so true. And it's hard too. You're spending that time with family, you're having dinner, and your mind's still going, right? You're thinking about those things you didn't get done. And really, you just need to go write them down sometimes. So that way, it's there, right? You're not having to keep thinking about it. So that way you can be present with your family. I love that first thing too in the morning, just like, man, you got that hour or so with the kids, man, they're just not going to forget that, right? If you're consistent with that over time, it's going to such valuable. Tell us how you like to give back.
Yeah. So we actually, we've been doing personally, I've been doing a lot of things. Right. I work a lot with my university. I try and speak whenever I can at my university, and just try and give the knowledge and the information back that we have. One of the things that we recently started doing, we have, I think, 10 to 15 episodes up. We just started a podcast, and really what it is, we're trying to limit the sales pitch or anything like that. What we're trying to do is I'm just trying to distill knowledge, right? Little nuggets of information about real estate, so that someone who might be interested, who's tired of their job, or who's just kind of frustrated with their current situation, I just want them to hear the nuggets of information that they can hopefully take and go and use for themselves and apply to their own lives. And so we just started that. It's called the Executive Real Estate Investing Show. It's got a website, executivereishow.com. But that's been one of the main ways. And it's kind of interesting that, it takes a lot of time and energy and effort in order to do that and to give back in that way. But we feel that, right now, the knowledge that we've gained and being able to disseminate is really the most valuable thing that we have at the moment.
Incredible. Yeah. Knowledge is power. And when you can pass that along to others, right, it's great. It's a great avenue to do that as well. So Michael, pleasure to just get to know you a little better personally and have you on the show and allow you to just share your expertise with the listeners. No doubt, just a great advice on many different things. That 240 unit deal and the financing to the TIC structure, to the SPE, to even your daily routine. I just think there's so many things there that are so valuable for our listeners. Man, if you can just apply a couple of those things today, you're going to see a difference, over time. No doubt about it. Michael, is there any other way that people can get in touch with you and learn more about you all?
Yeah, absolutely. So you can go to our, we're vertically integrated. We got a lot of different companies, but you can go to Overland Capital Corp. That's CORP for corporation, overlandcapitalcorp.com. And on there, one of the first things you're going to see is schedule a call. It's a big button. If you click on that and schedule a time, that actually links directly to my calendar. So I personally do all of those calls right now and plan to do that for as long as I possibly can. Those are really important things to me. So if you wanted to, I'm happy to talk to anyone on the phone, no matter who you are. If you want to get a hold of me, like I said, overlandcapitalcorp.com, schedule a call. It's not going to tell you that it's with me, but I'm telling you right now, I personally take all those calls.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.